From the morning reading, stock futures reversed overnight collapse after the Trump win. Steel and financial stocks soar. 6 of 10 sectors moved higher on Wednesday. XLF, XLV, and XLI were the strongest sectors, while XLU was the weakest sector. Oil futures rose 51 cents to close at 45.34. Breadth strengthened compared to the prior session as advancers led 1697 to 1383 on the New York Stock Exchange and led 2036 to 771 on the NASDAQ. On the S&P 500 snapshot, the S&P 500's futures plunged during the evening session during the presidential vote tally, but in a surprise to many analysts, the Trump win triggered a buying spree. The index was indecisive during the first 90 minutes of the session and rose in a couple of waves to its 1.43% intraday high in the final hour of trading. The final score was an impressive 1.11% gain, the third day of a rally that has erased the 9-day sell-off that preceded it. Far more dramatic than the Trump equity rally was the sell-off in treasuries. The 10-year note closed the session at 2.07%, up an astonishing 19 basis points from the previous close. In other news, the S&P 500 managed to rally more than 6% from its lowest point of the day, which had been a multi-month low. The last time it did that, stocks lost more than 4% the next day. Usually, though, buyers followed through longer term on such events, especially if stocks were not in a bear market at the time. Stocks shrugged off the only real historical comparison. The election surprise can only realistically be compared to 1948, after which stocks declined immediately and severely. Instead, the Dow Industrials have moved from a multi-month low to nearly a 52-week high in less than a week, a feat accomplished only twice before since 1898. Bonds got hammered. Both medium and long-term bonds suffered their worst one-day losses in history on Wednesday. There have been a handful of times that the 10-year Treasury yields jumped more than 5% to a 6-month high, which were often fake-outs. If yields continued higher in the short term, though, those gains tended to stick longer term. Wednesday was the most mixed-up day in 14 years. Since 2002, we've tracked total number of points gained and lost among S&P 500 components each day. In that time, there have been 52 days when the component stocks in the S&P gained 700 or more points on a day, and Wednesday they gained 810 points. On those days, the most total points that declining stocks lost was 99 points on September 10th of 2008, but on Wednesday, the declining stocks in the S&P lost a total of 399 points, meaning it was a split market more than any other day in 14 years by a factor of 4. There is no precedent for this, but severely split markets tend to be bearish, and we consider this to be a minor negative for the stocks. The stocks rally on the Trump victory. Financials, healthcare, industrials, materials, and energy had big gains. Stocks tied to aluminum, copper, steel, and coal surge. 10-year Treasury yield surges above 2%. Dividend-paying stocks like utilities tumble with bond prices. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:12 a.m. Mountain Time, and I am recording this in preparation for the market day of November the 10th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive in. Morning report. At the time of this cut, the 4 U.S. broad-based indices were all up fairly strongly. S&P futures are up about 12 points and are about 0.5% up from yesterday's close. Russell's futures are up about 1%. NASDAQ are up about 0.2%, and the Dow futures are up just below that 0.2% mark. Crude oil is down about 0.7%. Euro is down about 0.33%. Bonds are down about 0.25%, and gold is up about 0.2%. In overseas action, you have China up about 1.4%, Hong Kong up nearly 2%, Japan absolutely on fire, up about 6.7%, Germany up about 0.75%, and the United Kingdom up just above scratch. In terms of macroeconomic reports for today of note in the United States, you had the weekly unemployment claims, you had the FOMC member Bullard speaking, nat gas storage, and the 30-year bond auction. Looking forward to tomorrow, we have FOMC member Fisher speaking, along with the University of Michigan Consumer Sentiment Report. Also note that that will be out during market hours. In terms of current volatility, we've had a classic vol crush. While somewhat elevated, the short-term VIX is now at 15.36. That is way down from where it was 1 and 2 sessions ago. So with certainty comes resolution, and that vol was taken out of the market quite quickly. One of the things to keep in mind is as we took the 9-day consecutive series of drops, and then had a bit of a rally, and then a huge overnight drop with the Tuesday night election tally being counted, and then the huge rebound. You sum all that price action up, what that comes down to is, and we'll go ahead and go to the chart to show this. So during this period right here where it was dropping, this was when Hillary was dealing with the email reports from the FBI and so forth. And then, of course, we had the Friday, or the weekend release from the FBI that no charges would be coming. And then, of course, then the election itself. Well, if you break all these phases down, when there was uncertainty as to who would win, the market deteriorated. Again, here, when it was thought that Hillary was going to be a winner, that a winner was determined, the market rallied. During the overnight session, when it was unknown who was going to win, the market fell off sharply. Then as the market determined that Trump was going to be the winner, it rallied. So what this really is not the market liking Hillary or liking Trump, but simply that the market liked to know that there was a winner and who was that winner, so they could start to price in the winners and losers and the impact of that expectation. But ultimately, mostly it was about knowing who was going to be the winner. And so a pretty interesting contrast. Conventional wisdom would tell you, and many people were saying that if the market were to experience a Trump win, that we would be down 4 or 5%. Well, ultimately what this told us is that it wasn't about that Trump won or even that Hillary won, but that the market wanted to know that there was a winner and that there was not going to be a recall or lawsuits or kind of some sort of messy outcome in which we would drag for weeks trying to figure out who the winner was, but that we have a winner and that we can price that in. And remember, one of the key tenets of technical analysis is that all information is priced into the market. Well, the market does not like indecision or the inability to be able to price these kind of key factors in. So now that we have these answers, we've seen this reset. And part of that, and we're going to get into sectors in just a moment, but part of this is that we're going to have some winners and losers, and we certainly saw that with yesterday's action. So volatility got crushed as soon as we found resolution. Now, skew is still somewhat elevated. It's in the caution area, in the warning area. And we probably have about a 10% probability of a 2 standard deviation move in the next 30 days is the indication there. So kind of be aware of that. Not everything has gone to hunky-dory. Market is in normal bull market mode yet, but certainly we've seen an awful lot of resolution. IV percentiles have also fallen way off, and where we were just a couple sessions ago in the 70s on the S&P, we now have dropped all the way down into the bottom third of the annual range. The S&P at a 28, the Russell at a 22, the NASDAQ at 25, and the Dow at a 26. We use this on standard deviation moves on a close-to-close basis, and remarkably, when it was all said and done, after some 140-point range on the S&P in yesterday's 24-hour action, we ended up with a no standard deviation move on a close-to-close basis on the S&P. So, for folks who just kind of sat on hands during the entire event, not a lot, in quotes, happened. But for those that, tried to trade short term, it was certainly a very, very volatile day. We did end up with a 2 standard deviation move on the Russell and a 1 standard deviation move on the Dow. So be aware of that. In terms of, back to these charts, we'll comment a little bit more. So you had this historic move down, you had the reversal right at a prior support area, and then all the way back up, break of the diagonal resistance, huge confirmed breakout, and it closed just below the kind of upper area of the shorter term range. Now, it certainly went above this swing high and closed near these swing highs, but in the overnight thus far, we have come up and actually broken through the upper range of these swing highs and are at this point pulled back a little bit from that and are trading right about the area of these prior swing highs. So frankly, at this point, we were within about 11 points of the all-time high on the futures market, and it's hard to believe that we won't go back up and at least challenge the former all-time high, given the nature of this move and the proximity. It'll probably act much like a magnet to this test. Now, whether that test can get through, we would say that would be resistance until proven otherwise. You see, we've had multiple touches in this area, and consider this an area, not a specific price, but in this area, we've had multiple touches. So a fifth time would likely be treated as an expectation of resistance until proven otherwise. Now, if we can get a confirmed breakout, then we would have, what we call have achieved something. So far, so much of this action has just been really sloppy and volatile. And we predicted that there was going to be volatility. If you've been listening to these sessions in any kind of sequence at all, we'll likely see some continued volatility, but we'll likely see a slower, more bull market progression as we get up towards these areas and then start to test them. If we should break out, then obviously we have a brand new market condition that could be available to us potentially, and then we could have a slower grinding kind of bull market, maybe a more normal bull market, maybe even a potential for a trending bull market. So all those things are certainly in the realm if we can get up above this, probably first of all 2191 area, but then probably 2200. Round numbers always kind of seem to serve as their own kind of hidden resistance zones. But if we can break through that 2190 to 2200 area with a clear breakout, we would likely see some further potential for bull action. Now, if that doesn't happen, if indeed we come up here for the fifth time and this is resistance, then we could very easily see a market that just remains in the range, much as we have had in these past several months, really going all the way back to the post-Brexit vote. If we look at the Dow, very much same pattern, the break of the horizontal resistance. We actually last night had a new intraday all-time high on the Dow. So amazing that in a course of less than about 24 hours, you go from 17,418 all the way up to 18,714. in less than 24 hours. So that's what the pricing in of news does for you. And then the NASDAQ is also approaching all-time highs. And the Russell made a huge rebound here and is also approaching its former area of resistance, including the all-time high at 1263. So very much the same story on all four of these, and where we might have differentiated about relative weakness and so forth, really all four indices have broken those patterns and really are closing in towards the area of resistance and all-time highs. Let's take a look at some of the other markets. Crude oil is pretty much denigrated into a sideways neutral bound market, so not a lot of trending being evidenced there as of this point. Of course, gold had a big move, and you see with the big wick there, when there was fear and uncertainty as to the outcome, are we going to end up in months or weeks at least of uncertainty as to the election outcome? Big spike there, but as soon as it was determined that we had a winner, no matter who the winner was, that we had a winner, everything calmed down and we're back into the pattern on gold. Now, where does gold go from here? This looks like a rounding bottom. It's even perhaps starting to set up as a bit of a cup and handle kind of pattern. A lot of overhead resistance up here, though. So gold has been such a sloppy technical chart for several months now. This is very, very difficult to be able to forecast with any kind of probability. So just kind of keep that in mind. I mean, it had been in a very nice, though sloppy, bullish trend, but that broke down, and now we seem to be potentially setting up for a bullish breakout move, but there's an awful lot of resistance up above, so it's going to be quite a dogfight, I would imagine, on the gold trader charts. And then also, let's take a look at the dollar. Dollar's played such a huge role of late, and you see dollar is up right against the former swing high. So dollar is in play to be making a break of its own. Has not yet done it, but certainly is in play. And then bonds. Bonds got crushed, and certainly along with that went many of the interest rate sensitive stocks, such as utilities, REITs, and dividend-paying stocks like large caps that are, largely bought for safe haven status and so forth. A lot of that was unwound with this price action yesterday, and that has continued to build. So in terms of bonds and where does it go from here, we could see the bond market drop down into the 153 handle without too much of a surprise. There really isn't much support until you get down to that area. And once you get to that area, 151 and change to 153, there's a significant amount of support. So we probably would see the bond market stabilize at that point. And let's see here. Let's take a look at volatility. Of course, we talked about the vol crush. And of course, we had the VIX up around 23, and then as we had satisfaction by the markets that there was an answer to the elections, we now have quickly crushed, and we're down actually below a 14 already. So in only 3.5 sessions, we've gone from 23 to below 14, which is the realm of normal bull market. So very, very quickly took that volatility out of the market. In terms of long-term forecast for volatility, that also has been significantly reduced. Still a little bit elevated. We would not be surprised to see a little bit of a little bit more volatility in the days to come, but that should start to calm down with each session. Okay, to the daily report, and I was just double checking about this market phase 5. We had the break of diagonal horizontal support. I'm waiting to look, or I just took a look to see if we had actually changed market phases, and certainly price action is now above the 10, and the 10 and the 30. And we're looking at a potential change in the market phase. We've not had crossover yet, so we'll continue to watch this the next day or two. If this price action holds, we'll likely see an improvement in the intermediate term market phase. We have seen some important changes in other areas. In terms of the three market timing signals that we follow here, the first one comes to us from IBD, and we saw a change there. We went from the uptrend under pressure, the warning zone, into confirmed uptrend. So this is first day confirmed uptrend. First day confirmed uptrends have had some history of choppiness in recent months, but it's still significant to note that this has now had a follow-through day to the upside and has now signaled a more normal bullish posture. Also, the GMI index has improved significantly to a 5 out of 6 and a 7 out of 8 on the GMI2, though the sell signal is still in place. I suspect that that one also is getting close to switching. So not quite yet there, but certainly dramatically improved with the price action of the last couple days. And the third mechanical signal comes to us from Stock Charts Decision Point Scoreboard, and we see also there, after the prior session in which the Dow on the short term went to bull on both signals, we now have the S&P 100 and 500 also going to bullish signals on the short term. Now, this is still a very, very messy chart and not a lot of consensus across the time frames, what we call the stack. So we have, overall a bullish signal on the short term, but the intermediate term is mostly neutral to bearish, and the long term throughout all this price action in recent months has been mixed signals. So this is probably a sign of further chop and overall long-term indecision until we get agreement between the time frames. So we have a situation where consensus is very much improving conditions on our market signals, market timing signals, but yet not a clear all-out signal to either side. So this is a market in transition, and markets in transition can degrade, and they can also start to coalesce and become all bull. So just kind of keep that in mind. It is not yet an all clear, but we'll also certainly note the very much improving conditions. Position sizing opinions on both models are now 100%. So dramatic improvement there over the last couple sessions. We've also had pretty significant improvement in the terms of the market posture, the intermediate term market posture. We now have a weak bull on our primary signal coming from the S&P, and it has gone all the way to a 41 in very quick order. This goes up over a 50, and that will turn into a strong bull. Now, the Dow's already a strong bull. The other two markets, though, the NASDAQ and the Russell, are still weak bulls. Now, this is all up against the face of a strong bearish sentiment line. So this can also lead to these bull moves being shorter counter trend type moves against the face of a longer term bearish sentiment. So let's not get ahead of ourselves. We're going to recognize the improving conditions, but we still need to see significant improvement in these overall indicators before we kind of give that all clear signal that we're in a healthy bull market. We're not yet in a healthy bull market. In terms of the hedge warning status, we have taken it from a level 3 down to level 2, which is still the caution light, and we think that is most appropriate given the mixed signals that we have from above. But we do need to recognize that conditions that were possible for a crash, and certainly in the Tuesday night session, that was absolutely realized. We have at this point, with the bullish action of the last 24 hours, subsided in the risk of that kind of a crash in the intermediate term. In terms of the three strategy opinions, the option income strategies, the VIX is now back within the acceptable window to initiate new positions. Caution should be suggested, though, while noting that the hedge risk level is decreasing. Volatility conditions could remain somewhat elevated for a few more sessions. Cover call strategies and put selling, these are borderline acceptable at this point to initiate new positions. Consider relatively defensive structures. Remember, we're still in a zone where we've got a lot of mixed signals on the market, timing signals, etc. So very defensive structures with 2-to-1 in the money versus out of the money strikes. Also 2-to-1 ratios of low beta versus high beta. Also be aware, if you do that, some of these interest rate sensitive positions, which can also be low beta, there can certainly be an overlap there, that they're perhaps in a bit of a headwind with respect to what's happening in the bond market. So just kind of think about not just any low beta, but what kind of low beta position you might be looking at. And of course, you could always leg into positions through out of the money put selling, and always consider the position size and that what are you willing to own should that be assigned to you. In terms of the specific warning areas, we see quite a bit of improvement here. This was a sea of red yesterday, and we still have some warnings here. Market in decline is still present. Distribution day count is still high. The skew is still elevated. The current day, 10-day expected move warning is still up over 40, though this was up over 80 just a couple sessions ago and has now dropped into the 40s. In terms of the trend, of the three potential warning areas, we still just have the one, and this one certainly is at near-term potential to improve to a more bullish phase. And the key intermarket risk aversions, we've seen change here. All 5 of these have now flipped back to risk on. So significant improvement across the various indicators. From a sentiment standpoint, we've also seen some backing off from the extreme fear that we had just a week ago was at 18, now up to 43, and getting into the area where this would be really considered more neutral. We talked a little bit about sectors earlier, and we'll mention one thing here that, much of what was happening yesterday was kind of winners and losers being sorted out. So you had an interesting situation where on the New York Stock Exchange, new highs, new lows, you had very high numbers on both the new highs and the new lows. So ultimately, while much of the broad market was strongly up, if you were in an industry group or a sector that was expected to perhaps, not be as favorably, set up for a Trump administration, you probably took some hits yesterday. Whereas on the flip side, many of the healthcare components were up 4 and 5%, as they would be expected to fare better under a Republican regime as opposed to a Democratic regime. So there was a lot of winners and losers being sorted out yesterday. So this was not a day where everybody was up. And you notice there's a fair amount of red in some of these sectors. Much of this, though, related to an interest rate and inflation kind of expectation, and that hitting from the bond market and ripping through the various other companies that are interest rate sensitive, such as large caps and these consumer staples, these like kind of large cap kind of organizations. So kind of keep all that in mind. Okay, we've gone very long today. It's been a lot of news, so we're going to go ahead and wrap up, get this thing to publish. Got to do the disclaimers, though, as always. Hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom to take you to the full set of disclosures. And in the meantime, manage your risk each and every day, and you'll find that your consistency will improve with that. Go out there and learn something each and every day, and good trading to you.